Good morning, ladies and gentlemen. Well, that was an interesting week, wasn't it? Now, the risk dial is still not convinced, and in fact, on Friday went down because the volatility term premia actually increased. So, what it's saying is that this is some sort of a retracement which now will either continue or we will drop into risk off. Do I think that that would be very significant immediately? No, probably not, because risk-off signals can be short and can also be wrong. As you can see, you have a number of them. But during a period of QT, that is to me quite unlikely. It's unlikely that during QT you get as many false signals as you did during a period of QE. But we shall see. And the important thing to understand is the main reason why I think that something is going to happen quite soon is that these volatilities stacked are still very high. And the only one that is not really participating is the technology sector. If that now starts going up, then volatility stacked will be very, very high indeed. And things will change very, very rapidly. But I think we have time, and I'll explain to you now what I think happened last week, why we got it right, and what might happen now that is going to change the current picture. Okay, so let's start with the theory. Last week I told you that the QRA is important because it affects the term premium of the bonds. If there are a lot of coupons being issued, term premium should go out. If there are fewer coupons issued, term premium should come in. Now, unfortunately, this hasn't been updated since the 24th, so term premium I know are up here. I haven't calculated it myself, but I know a man who has, and I'm taking that with a pinch of salt because there are many models of term premium, but more or less they all agree in direction, if not as to magnitude of what it is. Even this model here that the Fed uses should be quite a bit lower. We've moved 50 basis points in coupons in the 10-year note, so it should be roughly 50 basis points lower. Not quite, but roughly. So that means that we are barely positive, if positive at all. So we've gone from, 40 basis points back down towards zero. Whether it's 5 or 10, I mean, who cares? But it's barely positive. I would argue that with 348 billion worth of coupons to be issued over the next quarter, and we know that we have 3 auctions next week, it's very unlikely to me, and I always play the odds, that term coupon goes negative. We have a hell of a lot of issuance, whatever people might think now. And for term premia to go negative, we really need data on the economy, that the economy is turning over in some way. We got some indications last week that employment conditions are not as good as they used to be. Is that a recession? No, I don't think so. I think we need much more data, many more misses, before we can say that the economy is weakening, and then term premia can probably turn negative even with all the issuance in the world. As I always say, risk off swamps everything. And we don't have risk off at the moment. And I don't care what the model is going to show in the next week or two. I think that could easily prove false. What I care about is what term premia are telling me and what data is telling me. From term premia down here, I think the odds of a further move of anywhere near the magnitude we've had is actually terribly unlikely. And now let's have a look at real rates. Now, real rates probably are somewhere around the 225 mark. And I think that unless real rates start dropping well below 2, they are going to be supported at around the 2% level. I mean, that's a bit of a tautology, but what I'm trying to say is that data will move real rates. The only reason why real rates are going to fall below 2% is because data says that the economy is now in a very bad place. We don't have any indications of that. I mean, absolutely none. I would much rather miss 10, 20, 30 basis points than start betting now that the economy is going into recession. Everyone who's bet on that this year has been completely wrong. And I think that the odds of going from 4.9% GDP in one quarter to negative in the next are almost zero again. So I very much prefer the explanation that what happened last week is very simple. A market that was caught short of duration for very good reasons. Because remember what I've been telling you. They were absolutely caught with their pants down during the last QRA in August. They got it completely wrong. They had to hedge for extra supply that they had not budgeted for. Then they had to extrapolate that all the way into 2024. And they did. And they came up with the same figures that I did, which was issuance over 400 billion of coupons in Q1 2024 and going out. And then Janet played the trick on them of saying, oops, don't worry about it, we'll issue many, many more bills and basically drain the RRP. And then they had to scramble. They had to cover their positions and nobody wanted to give it to them at a sensible price. Then we got a bit of weak data and they had to scramble even more and faster. So I think that what happened last week was a combination of many things which came up with a perfect storm for anyone who was short duration. And duration means both long bonds and equities, right? Equities have got the longest duration of everything. And that is why we got it so right. Had it been just the QRA, I think we would have gone maybe half of the amount that we went. But we had the perfect storm. We had weak data, we had the QRA, and we had an FOMC which was nothing. I mean, what did we learn from Powell? I learned nothing. So we had the perfect storm. Things have probably gone even too far. And the way we will know if they've gone too far or this is the start of something different is by looking at, first of all, the term premium, because it'll go negative only if there's something very badly wrong here, or looking at here the real yields. If they start dropping below 2, also they're telling you there's something very wrong. And a combination of the two with risk off in the model, I think really gives you food for thought and probably a big shift to bonds from equities. I really don't see why that should happen at the moment. But if anything, and mark my words, we're now much more data dependent than we were a week ago. So let's have a look at what yields actually did last week. This is the 2-year note. Just like I thought the 2-year note was stuck between 5 and 527, I now think it's stuck between 5 and 475. The idea that the Fed is going to ease anytime soon is actually very fanciful. Oh, and a quick word of warning, I've been told that I wrote 275 in a tweet last week. Obviously, I mean 475, I'm sorry. You know, my brain works faster than my fingers. So I think that we are stuck between 475 and, something like this, 494, 495. We probably have a little bit more to go in the next couple of days, and I know that I'm long of twos and I'm long of fives, but I'm really not betting that we're going to go very far away, and the amount that I'm long here is very small. So all we really did is go from one level that we were threatening to break to the upside, basically down to Bollinger Band support. If we change this to a weekly, we will see really that last week was not all that significant in the greater scheme of things. Do I think that we can, come down towards this 427 over the course of the next 2-3 weeks? Yes, but I think we're absolutely stuck in this range in 2s, 5s, 10s and 30s. What interests me is what the yield curve is going to do. So let's have a look again at what the 10s did, which is much the same as 5s. They basically went down to support. Next week we have the auctions, 3s, 10s and 30s. It's more probable than not that we retrace to about 470 for the 10s auction, and probably something like here 488, and get that kind of a coupon for the 30s, and that is going to be that. So really what the outrights have done is not very much. I mean, yes, they've moved 40 basis points in the 30s. That is a significant move, but it's not that significant given where we have been in this range. We're not busting through ranges. To bust through this range, I think we need data, and that's why I think we are more data dependent now than we were. I think it's that simple. But the yield curve is the one that interests me. And while we flattened for the best part of the week, we actually started steepening on Friday. And that tells me that people are still waiting for this yield curve to disinvert. And I think this now is a massive level, this 16. I think if you start busting through 16, there is something very, very badly wrong, because then we will have done a double top and we'll be taking out most of what we did all the way back to, a year and a half. We will be taking out a year and a half of steepening, and that to me is going to be very, very significant. And then we really could be in a period of risk off, where, because let's face it, what's that going to tell you? That's going to tell you that the Fed is very close to cutting rates, or that the market is telling the Fed that it's very close to cutting rates. And if we look at the 5s, 30s, I think that has further to go, but we start busting through here around the -40, a weekly close below -40. That also tells you that we are going to go in a period of risk off. So, I think for the next week or two, we're going to do nothing. We're going to go sideways. We're going to stop people out one way and the other. But I think the way to play it from now on is long of the very short end, 2 to the belly of 5s. You are looking for levels to put it on, to go long at those extremes, and then we will see. But the risk reward is to be long the short end. The other thing that I want to point out to you and argue is that if this was the start of some concerted move down in yields worldwide, Germany would have kept pace. Because let's face it, Europe is, if there's going to be a problem with recession, etc., it's going to start with Europe. And really, we got absolutely nothing from Germany, relatively speaking, last week. This is the Schatz, which really, if there's a problem, should move the most, right? 1, 2, 3, 4, 5 days. We closed 307 last week, and we closed 305.5 this week. So the Schatz has gone nowhere. The bobble has gone a little bit more, right? But essentially, if we say that 6 basis points is something, then it's not much of an anything. The 10-year actually went more because it had to be more or less where trade with the US, but really the move there was also very, very slight relative, compared to what you would expect if this was the start of some major move down in yields. I think the 10-year, the Bund here is stuck between this level, around 257.5, and we're, maybe go and fill this gap up to 275. That's about it. So Germany is telling you that, this could be an ABC, right? And then we go again. Who the hell knows? But what I'm saying is that if we were now betting on some kind of a recession, people talk a lot of bollocks, but if we really were looking for that kind of thing, this would not be where we were. Okay, we would be a lot lower than this. And all that really happened last week is that people covered their positions. And you can see that best from the butterfly of the 10-year notes, the Bund in the middle, and the BTP on the outside. I told you down here, not good risk reward, right? And boom. But do we really go any further than this? 362? I probably want to be short that butterfly there, around 362 to 360. That's where I think that we can actually start going down and retesting. And what would that mean? That would mean 10-year notes go higher in yield, BTPs go higher in yield, and the Bund does nothing, relatively speaking. So basically, a reversal of what we've had over the course of this week. This week was just people who were absolutely wrong in their duration positioning, covering and getting a perfect storm of nobody wanted to sell it to them aggressively, and the data which made people even more reluctant to sell it to them. So we got the scramble. But the spreads tell me that this was not a significant start of anything. And just to emphasize that point, this is the Bund against the 10-year note. So tens. What happened? Basically, we went from unsustainable levels that I told you, 202. I mean, ever since we were breaking through 152, I said that is going up, and that was probably the target. And what happens if we go back? We go back to this kind of level, 183, maybe 175, 172, and then we trade around. So this is still perfectly normal. There is nothing to write home about. I would love to see this down to 172 because I think that's going to be the bargain, but I don't think that we're going to go much lower than, say, 180. So 180, I start putting some on, and all the way down to 172, and I think that will be a bargain. I think we're going to retest 202 at some stage from these levels, whether it's 172 exactly or something like 177, I don't know. But if you've got an average of 177 on these buys, I think you will make 25 basis points without any problem. And that tells me there is absolutely nothing going on in terms of absolute move in rates worldwide. Just bad positioning, people getting stopped out all over the place, and it is what it is. And just a quick word for a very good potential risk reward next week. This is now 30s. If we see it back down at these levels, and I never saw it at these levels, so I think that might be a bum print. But if we do see it at these levels, 176, 177, 178, I think the risk reward next week is excellent ahead of the auction. So I think we probably go and fill this gap up to 187. So you have 10 basis points here for a 5 basis points worth of risk, at least a 2 to 1. Okay, so to me, that is going to be a really good trade if we see it, and I will tweet it to you if I see it at the time over the course of, say, Monday and Tuesday or Wednesday. After that, it's just too late. So the dollar. Well, just as 10s 10s and 30s 30s, US Germany topped out, the dollar's topped out. So basically the dollar is more or less leading it as opposed to anything else. What do I think? Do I think it goes hugely lower? No, I think 104.60, 50 is about as low as it goes. And it could easily retrace to 105.88 without any problem whatsoever. I think we're still stuck in a range. I don't think that we are going to move a million miles to the downside. I really don't. So this kind of level, 104.20, 50. I'm small short of dollars from Friday. I think I'll probably cover it on the open. If I have a look at euro, I think basically we are very unlikely to break 107.80 area. In fact, it's probably a good risk reward to go short at 107.80. And that basically tells you that we're not going to go a million miles in the interest rate spreads either. So it's really as simple as that. I really don't want to be short of dollars. It was, a very tactical, quick play. But there you go. I just feel uncomfortable being short of dollars, and I'm already regretting keeping it over the weekend. But I'll get out on the open, I think. These kind of level, 107.85, I think it's very unlikely to break higher. The pet rock actually now has an opportunity to move lower. I was quite surprised that on Friday we didn't go up. And that tells me that everyone's long. And if nothing happens over the weekend and the geopolitical risk starts receding, etc., I think, next week we could get a downward surprise in gold and certainly touch this 1959 level. I think that people got overexcited in gold, and as I said, I really could not see who in their right mind would own gold over real rates, and I've been proved right. And since I can't see real rates going down from the level that they are now, I think gold has a real opportunity to get smacked. An opportunity doesn't mean he's going to take it, but I would have thought 1958 is the minimum that I expected to trade next week. And possibly it could go all the way back down to 1881. I mean, I just don't see who on earth wants to own gold and what for, but that's for them to know. I would be very surprised if after the action on Friday and all of last week, where gold could not do anything compared to real assets and in fact closed the week down, I would be very surprised if it holds up and doesn't go and trade at least in the mid-1950s. DBC, absolutely nothing to do here. This is a market which is completely dead and doesn't know which way to go. But what is interesting is that gold against DBC has now retraced from levels that were probably, unsustainable, and it's now at a level that allows for gold to retrace and for DBC to do relatively better than gold. It's not really all that easy at the moment because oil is not going up, which is the surprising part. But, the US is going to replenish its strategic reserve at 79. So we are a and that's us away from trading 79 in oil. And that tells me that oil really, the downside volatility should really start disappearing. And if DBC is to go down, I find that very difficult to believe with oil not going down because DBC is 60%. So the risk reward really turns to being short gold and long DBC, if one thinks about it logically. I don't think it's going to be a trade that moves a million miles, but it's probably something that tells me that gold can go down 2-3% without any difficulty at all at these levels. So it's not a buy DBC rather than sell gold. Makes more sense to me than owning gold and being aggressive with it. I'd buy some put spreads. Right, let's have a look at my clean SPX chart and tell ourselves a little story about what has happened over the past several weeks. Let's enlarge this area and let's start here. So August the 2nd, the last QRA comes out and I hedge my entire long book. Market then proceeds to go down. Stupid little retrace, God knows why. We then go back down. And now we are waiting here for the QRA, for the next QRA. QRA comes out. As I tweeted to you, I cover immediately every single short I have. Bang, bang, bang. Okay, so where does the market go? Well, the market, to me, goes up here. Why? And probably stays up here and does one of these for a 1, 2, 3, 4, 5, 6 days. Stays in this kind of range. Are we fundamentally, should we be higher than the last QRA? No, I don't think so. Because that is when we found out that we're going to have 340 billion worth of duration per quarter to digest. And this is where we got confirmation that we've got the same amount to digest, but we were just we were discounting more. So does it go to here? I mean, it's possible, 44.23. This kind of area, I think, is unlikely to be sustainable in the short term. I think in this kind of area, I think it's more likely that it retraces down to this kind of area than it goes up. I really don't see what has changed last week, apart from a whole load of people being badly positioned for an event and having to scramble. For us to go outside of this area, we really need some data. We either need data that says the economy is great, but the Fed is now done, and therefore, you're going to get complete calm in the bond market. It's not going to go anywhere, and therefore what do? Well, I suppose you buy equities because everything is going to be calm in the bonds. We've seen the absolute highs. Nothing's happened, nothing's broken, credit is fine, and therefore we buy equities. Or we get the completely different narrative, which is, oh my God, the economy is collapsing, it's risk off, bonds are surging. Well, in that case, equities can't stay up here, can they? So to see if bonds or equities are going to lead in the immediate future, because let's not kid ourselves that we can see much further ahead than a week or so, let's have a look at SPY TLT. Does that chart look like it's immediately going to break down? Not particularly. It might look slightly more bearish And, this could be an ABC, in which case we go down to here. But that is not a massive move, right? All that means is that bonds go sideways and equities retrace a couple of percent. And that's that. If we look at ITOT over government, so the totality of the stock market over the totality of the government bonds, it doesn't really tell me very much. That's already completed some kind of retracement. That was a great level to buy it, yeah, and now it's going to go sideways a little bit. I just don't see that these charts are telling you that there is an immediate risk of risk off. Because if there were, I thought over government would be trading at the lower end of these Bollinger Bands or threatening to break the lower end of the Bollinger Bands. I mean, this is where we started 2023, and then means we are well higher. This is where we started 2022, and we're still higher. So what this chart is saying is that the totality of the bond market and the totality of the stock market have really not changed since 2022 when we started getting the dump. Okay, it's changed a little bit to the upside, a couple of percent in favor of equities. If we now start trading below these levels, that will mean that there is some sort of risk off going on. At the moment, I just don't see it. And therefore, I think that the most likely explanation for what is going to go on next week and possibly the week after, until we get some data which really gives us the direction for the next several months, I think a period of stability after people have been stopped out left, right and center is the most reasonable explanation of what you can expect. Final bit of logic I want you to have is IWM. Okay, so IWM is the most sensitive to rates. And this is your 200 daily moving average. And all we did is go from an unsustainable level to probably the top here. So I would have thought that you are going to also get clues from IWM. If that starts breaking 178, 177 to 178, you are, or even 179 something, you are going to get the clue that something is beginning to break. But in the relationships, I meant break. But until we start taking out those levels, this is nothing more than a retracement. Nothing more than a retracement, and even the 200-day moving average is still negative. So I really would not get overexcited about equities. Even if we look on a monthly chart, okay? If we look on a monthly chart of IWM, what's that saying? We can go another couple of percent and we still haven't done anything. What I think it's much more likely is that we are staying within this range now. That was the bottom, but we are staying within this previous range for the next couple of months. So a little bit of a Santa rally, bonds which are not surging anymore and therefore pressurizing IWM. So that is all I can see for the foreseeable future until data comes out. And this is why I think that we are now much more data dependent than we have been for a long while. Think about it logically. The Fed has now concluded that they are on hold. What is going to move them off hold? Well, it's going to be the market. The market has to lead the Fed now. If the 2-year notes start getting weak data and they start telling the Fed that they need to cut, the Fed will cut because they're just a bunch of sheep. So, honestly, you could replace the whole of the FOMC with a 2-year note and you'd get better results. So the market is going to lead the Fed from now on, and that means data is going to be much, much more important than anything else, or to a greater degree than we have seen up to now. Still very, very impressed with the Nikkei. It's like pushing a ball underwater, isn't it? It just doesn't want to know about going down below 30,400. And as soon as it does, it goes there, it just bounces to the top of the daily Bollinger Bands. However wide they are, that's where it goes. To me, this is a market which is also saying I'm a little bit dead now for, a few weeks. I doubt it breaks 33,500. But if it starts breaking there, that's probably your first sign that, SPX is not going to be all that stable. That's not what I'm expecting. Therefore, I don't think that Nikkei is going to go. But any kind of retracement back down to 32.2, that kind of level, 32.1, it still tells me that Nikkei is a buy over SPX. I still prefer it. It still seems to be much more stable, much less volatile to the downside, and much readier to bounce than any other stock market. I could have shown you a bunch more charts, including volatility, but it's really not all that significant, and I think I've told you and triangulated all my theories stroke how I see the market playing out next week, and to distill it, I see it doing relatively nothing. Just a consolidation while we absorb the auctions and we wait for data, which we don't have next week. We really got very little next week, and we have to start waiting for the CPI, the PPI, the retail sales, which are the week after next. So I don't see the market doing very much indeed, and I've changed the levels. I think what is worth looking at is now Bund BTP at that kind of 177 to 182 area, and the 10-year US Germany at the levels that are indicated to you, and the 30s. Those are the things that are worth looking at next week, because I think everything else in the outrights is going to be quite boring, or I hope it's quite boring, because otherwise my theory is wrong. But I can't see that this market is going to move a million miles away from term premium close to zero, and I can't see this market moving substantially away from the real interest rates that I showed you at the beginning of this video. I just don't think it's warranted, not until data tells us. Thank you very much indeed, and have a lovely weekend. Tweet you tomorrow.